Every empire thinks its riches will last forever. Every generation believes its money is different, unbreakable. And then, history shows up and proves everyone wrong. Money isn't stone. It's belief. Belief frozen into numbers. And belief melts fast. When belief breaks, savings vanish, markets implode, and wealth doesn't die. It moves not to the loudest, but to the most prepared. Here's the promise for the next 10 minutes, a simple pattern to spot late-stage bubbles, a practical checklist to survive trust erosion, a barbell play you can start this week. Stay to the end for a one-page cycle playbook and 3 panic pivots that turned collapse into opportunity, from Rome's shining coins to revolutionary paper to the digital dollars we trust today. Every system begins with confidence and ends with a test of that confidence. The pattern is old. First prosperity, then overreach, then the quiet erosion of trust. Collapse never starts with chaos. It starts with small invisible compromises we politely call policy. So how does trust die? Slowly at first, then all at once. Let's stress test the pattern across 2,000 years. Financial history isn't a straight line-up. It comes in waves, surging and breaking. Cycles repeat. Greed, bubble, peak, crash, despair and renewal. Tulip mania in 17th century Holland. A flower traded for a house because belief outran reality. The South Sea bubble in England. A monopoly dream that turned into money until reality turned the lights on. The dot-com boom in 2000. We were right that the internet would change everything. We were wrong about how quickly profits would follow. The 2008 crisis. Banks that looked invincible fell like dominoes when leverage met truth. And yet in every storm some survive and emerge stronger. The patient, the disciplined, the ones who understand the rules. They see opportunity in the ashes. Because danger and opportunity are twins in every cycle. Every empire thought it was different, until it wasn't. Every generation thought its money was unshakable, until the cycle proved otherwise. Today is no exception. By the end of this episode, you will have 3 things. A. Pattern to recognize late-stage bubbles. Checklist to avoid trust erosion traps. A barbell framework to survive. Liquidity shocks. The question isn't if another storm comes, but when, and when it does. Will you be an unprepared victim, or one of the few who see through the chaos? Because in every collapse, wealth doesn't disappear. It changes hands. Those who understand history hold the map to the future. Crisis isn't the end. For the prepared, it is the beginning. Byzantium lasted nearly 1,000 years. At its core was the solidus, so pure that merchants from Venice to Baghdad treated it like gold itself. Then came the quiet betrayal. Emperors diluted the purity, shaved the edges, stretched each coin a little thinner and stretched trust with it. At first, nobody noticed. Then trade slowed. Merchants hesitated. The coin that once united the world became just another promise nobody believed. When the solidus fell, it wasn't only the economy that cracked. It was the illusion of permanence. The lesson is brutal and timeless. Power struggles to resist creating more claims than real value. The smart didn't panic. They pivoted. Those who held real gold, land, or foreign trade routes outlasted the empire. The rest watched their wealth turn to dust. Trust has a test: purity, policy, and price signals. The early crack is the spread between paper claims and assets that settle in the real world. Mid-14th century, collapse arrived not through politics or coins, but hidden in ships and carried by rats. Between 1347 and 1351, half of Europe vanished. Cities emptied. Bells tolled without end. But while death devoured empires, the rules of money changed. With workers scarce, every remaining hand became precious. Wages rose. Serfs bought land. The same soil that once chained them now set them free. It was a reset. Collapse didn't just destroy. It redistributed. Those with liquidity, silver, grain, or simply the courage to act, turned despair into wealth. By the 1300s, Florence bankrolled Europe, kings, popes, and wars. The great houses looked untouchable. Then England's Edward III defaulted. The unthinkable happened. The great banks fell almost overnight. Merchants lost everything. Trade froze. The city that symbolized wealth learned the price of misplacing trust. And yet from the ashes rose the Medici. They realized finance isn't just lending. It is steering. They funded builders, artists, and thinkers, turning credit into culture and debt into destiny. From bad debt's ruins came the Renaissance. The takeaway is simple. Concentration and sovereign risk hide in prestige. Reallocation births new eras. Early 1700s. England drowned in debt. The South Sea Company promised salvation. It would take on the nation's debt and gain a monopoly on New World trade. Gold, silver, spices and slaves. Fantasies painted as facts. In London streets, fantasy became currency. People sold homes, farms and futures to buy shares. The poor begged for a single certificate. The rich risked everything for more. At the peak, price reflected imagination, not income. Then belief ran out. No ships, no cargo, no profits. Fortunes vanished in days. Even Isaac Newton couldn't escape financial gravity. He said, "I can calculate the motion of heavenly bodies, but not the madness of men." In the aftermath, reforms separated truth from speculation and sowed seeds for modern investing. The takeaway: follow cash flows, not slogans. Map monopoly claims to measurable throughput. By 1929, the future could only go up. The market became a temple of faith. Then, one October morning, the illusion cracked. Paper wealth turned to ash. Banks locked their doors. The invisible foundation of every dollar, faith, disappeared overnight. But when money dies, value doesn't vanish. It hides. Those with cash or courage bought land, stocks, and businesses for pennies. When the storm passed, those same assets, land, steel, oil, and ideas, built the next American century. The truth is cruel and useful. Collapse transfers wealth from the many who panic to the few who prepare. Liquidity is optionality, despair. Price is greatness. 3 late-stage signals show up. Again and again, first, hot leverage. Stories outrun cash flows and multiples untether from math. Second, policy patchwork. Short-term fixes conceal long-term imbalances. Third, trust leakage. A growing gap between paper claims and assets that actually settle when it matters. Here is a framework to survive liquidity shocks. The barbell. On one end, the safety bar. Flexible cash and high liquidity assets, sized to survive worst-case scenarios. On the other end, the growth bar. Selective risk with small position sizes, favoring durable cash flows. Position sizing should start small and add on confirmation. Cuts should follow rules, not feelings. Optionality means knowing what to sell and what to buy in the next 24 to 72 hours. Here is a 10-point trust erosion checklist. Earnings versus narrative. Story up. Cash down. Maturity mismatch. Short funding with long assets ballooning hidden. Leverage, derivatives, or accounting that mask. Risk, policy, sugar highs, markets that rally only on temporary support. Liquidity, illusion. Volume thick on good days, gone on bad days, crowding everyone. At the same exit, foreign exchange or commodity. Squeezes, margins snap under macro. Stressed are covenant drift. Debt terms get looser over time. Rollover risk. Refinancing depends on a narrow window. Settlement. Premium real settlement assets start trading richer than highs. Paper. When 3 or more flash red at once, prioritize defense and liquidity. 3 panic pivots when markets crack. Raise to breathe. Lift liquidity, reduce leverage and buy time. Aim for 12 to 18 months of runway. Rotate to real. Favor assets with use value or resilient cash flows that rely less on pure belief. Buy despair, not denial. Scale in only when prices reflect panic, not while the story still argues with reality. Execution matters. Use staged orders and accept small slippage for certainty. Keep a trade journal with entry reasons, exit triggers and invalidation points. Never let one idea sink the ship. Names change. Mechanisms rhyme. When supply breaks, scarce assets hold better than paper promises. When leverage runs hot, cash is a call option on the future. When trust leaks, settlement assets get expensive. The question isn't if, it is where we are in the cycle and what we plan to do about it. Crises don't erase value. They reveal it. To stand on the right side of the transfer, get the 1-page cycle playbook with 7 rules, a 10-point trust checklist, and the 3 panic pivots you heard today. Download it, build a when trust breaks plan tonight, and be ready before the headlines are next episode. How trust breaks, from coin clipping to quantitative. Easing subscribe and set a reminder so you don't miss it. Which moment in history changed how you think about money? Share it. The best comments will be featured in the next episode.